Could de-escalation in the Middle East send oil prices plummeting? Welcome to Market Insight, I'm Thomas Warner. Back in September, weakening oil demand from China and ample global supply sent oil prices to an 18-month low. Since then, fear of an escalating conflict between Israel and Iran has pushed ICE Brent back above $70 a barrel and even briefly above $80. But with the bearish backdrop still very much in place, could an easing of tensions quickly knock the bottom out of the crude market? To give you his take, I'm joined by Argus Media's chief economist, David Fyfe. Now, David, a very warm welcome to you. We know that there are some ceasefire talks due to resume in the next few days. Is fear of escalation the only thing preventing an oil price crash, in your view?
Well, Thomas, thanks very much for inviting me. I think you hit the nail on the head, really. What has been providing a floor at sort of $71 WTI, 75 Brent over the last couple of weeks has very much been the uncertainty around exactly what Israel might do in reply to the missile barrage that it was hit with from Iran. We think, or we assume that OPEC plus producers will be mindful of the fact that demand is relatively weak, not least in China, and that therefore they will adjust their production policy to try and avoid a surplus developing in the market. But obviously, that's the million-dollar question. Are they going to continue to act in a cohesive manner and prevent a surplus that would otherwise emerge if they were not controlling supply?
And it really is a surplus that is waiting to emerge. Do you have any sense that any of the OPEC plus producers are now starting to chafe against their self-imposed cut? We know that Russia, for example, is one that's supposed to have been overproducing, and they are extremely reliant on that income, aren't they?
Absolutely. You've got Russia on the one hand, you've got Iraq and Kazakhstan, for example, which have been singled out by the OPEC plus grouping as having overproduced, and indeed they're being asked to rein in their production and you reverse that overproduction between now and the end of the year. The plan is that voluntary cuts of around 2.2 million barrels a day will begin being dribbled back into the market from December. But I mean, we really question whether the market actually needs that incremental oil in 2025.
Just before we move on to talk about this week's BRICS conference, David, I do just want to try and get an answer out of you about how low you think crude prices could go in the event that the situation in the Middle East did start to ease off.
Well, I think you'd have to pair that with a further loosening of discipline amongst OPEC plus. Our working assumption is that they remain cohesive and therefore they keep a sort of $75 Brent floor under prices. If they don't, well, the last time we saw that happening was in March 2020, and prices went very, very low on a sort of monthly average basis to $30 or $40 a barrel. We don't think that will happen, but it's clearly a risk.
Let's move on now to that BRICS summit. They were discussing a potential new currency, and one of the obvious principal uses for such a currency would be to trade oil without having to use the dollar. And with that in mind, how significant do you think this week's meeting was for the oil market, David?
Well, look, I think there are certainly moves amongst this, what is becoming a fairly disparate grouping, and I think that's important because just as the OECD or the United Nations or any other multinational organizations find, it's difficult to formulate policy when you have such a disparate group trying to, set a joint set of priorities and policy preferences. I think they are certainly looking to try and loosen the dependence on international trade on the US dollar. But it's very difficult to see any of the currencies, whether it's the Russian ruble or the Chinese renminbi, replacing the US dollar anytime soon. There may be bilateral deals that can be struck, particularly for oil, in alternative currencies. But I think in terms of replacing the US dollar as the single most important global currency, that's unlikely to happen.
Well, the dollar very much in focus, not least because we do have that US presidential election coming up on November the 5th. So I think around 11 days now. Equity markets don't seem too worried about the prospect of either new president. But what about the energy markets?
Well, I mean, there's fairly disparate policies between the two candidates as regarding energy. And to simplify, you'd see a Harris administration carrying on with the Inflation Reduction Act and the support therein for electric vehicles and renewable power generation. President Trump much less enthusiastic about the renewables and climate change, and he's talking about drill, baby, drill. In other words, loosening the shackles that he believes US oil and gas companies face in terms of developing new reserves. I think the important thing to note is that both campaigns' aspirations may well be trimmed or restrained by the prospect of a split US Congress. So, in other words, the ability of a Trump administration to rip up the Inflation Reduction Act would probably be constrained by a split Congress. And similarly, any moves by a Harris administration to restrict leasing or to prolong the ban on new LNG facilities would probably similarly be constrained. So I suspect there may be administrative constraints on what both campaigns might want to do for energy going forward.
We shall wait and see. Argus Media Chief Economist David Fyfe, thank you very much indeed for your thoughts today. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.